Welcome back to my channel. I am super excited for today's video. We are talking to one of my mortgage lenders, Mike Schinas from the Vine Group. He's going to be sharing all things mortgages for first-time homebuyers and first-time sellers. But before we dive into this video, I just want to give a special thank you to my sellers who have opened up their beautiful loft today for this video. You know who you are. Thank you so much. If you're curious about this loft space, and you want to check out the full listing, check out the link in the bio. But without further ado, let's dive into the conversation with Mike. Hey, Happy New Year. My name is Dyson with eXp Realty, and I am so excited to bring this video to you. We are talking to Mike Schinas, a mortgage lender with the Vine Group, and we are talking all things first-time home buyers, first-time home sellers, and how to prepare for your mortgage in 2024. Super excited to have you here, Mike.
Oh, it's great to be here.
Yeah.
You know, making this type of content for our first-time home buyers, I feel like is a great way to really help people. Right?
I totally agree.
Yeah. So I am with Vine Group on the Johnson Andrews mortgage team, and fell in love with mortgages, decided to run with it, and here we are.
Amazing. We love this. Mike and I have followed each other on Instagram and TikTok for a little while, so it's really exciting to bring you on and kind of share your expertise with my audience. So really pumped. We on Instagram, on my stories, we asked you, first-time homebuyers and first-time sellers, questions that you would ask a mortgage broker. So we have a list of questions for you today to ask. We broke the questions down into two different categories. So first-time homebuyers and first-time sellers. We're going to start with first-time sellers. And the first question is around home equity. So how can I leverage the equity in my current property to make a down payment on a new home?
Yeah, great question. So there's a couple different ways that you can really leverage your equity. Number one is going to be the classic refinance, right? So that's going to be adding additional equity or additional funds on top of the mortgage you already have,
okay,
to then use that as a down payment, right? Now, that's a great way to do it, but the thing you have to take into mind is that amount that you're taking out right away, right now, is going to be charged interest on the total of your principal.
Okay.
Right? Where another strategy you can approach is doing actually a home equity line of credit or a HELOC. Now with the HELOC, that amount that you're drawing out, that's where you're going to be charged interest. And obviously it gives you the flexibility of doing interest-only payments.
Yeah.
If let's say this is an investment property that you do have and you're looking to purchase another primary residence, you can at least offset some of the costs that you'll be looking at instead of putting it all into one line.
Yeah,
right?
That totally makes sense. So you can use that HELOC, pulling out that equity, and you can actually use it in your down payment for
sure,
a rental property or a second property.
Exactly. But the one thing that we also have to consider is whenever you're drawing out more equity, it does actually count against you in terms of affordability.
Okay.
Right? So the way that we want to try to structure it is if this home that you're pulling equity out of is a rental, let's see if we can offset some of that cost by using that rental amount, using that rental income, right? So we do have to always take that into consideration, but when planning this type of move or this type of transaction, it's something that we go over just to ensure that you're going to be okay at the end of the day.
Makes total sense. Yeah. Awesome. All right. Next question is selling and buying simultaneously. I get this question all the time. First-time sellers feel super stressed about what comes first, right? It's kind of that chicken or the egg. So if I'm selling my current property and buying a new one, how does the mortgage process work for both of those transactions?
Yeah, so great question. Traditionally, and what people ideally want is to obviously sell their home and then purchase that new one after.
Totally.
Right? Now, there are instances where it does go the opposite direction, right? Maybe your home is not selling in time, or maybe you have a quicker close on your new property. And in that time where you don't have that access of funds, let's say you're trying to sell your home to get equity in order to use as a deposit or down payment on this new property, we actually have something called a bridge loan.
Right.
And what a bridge loan is exactly what it sounds like, is we're bridging that gap between the property that you're selling and the new property that you're buying, right? So when it comes to that mortgage process-wise, it's pretty straightforward. We would get your financing set up much as we would normally.
Yeah.
Make sure we have everything lined up for your closing. So all the documents are in, all the T's are crossed, I's are dotted.
Yes. Important.
And then from there, that's when we can assess if you actually need the bridge financing. So that's when we speak to yourself, being the realtor, and see exactly when that initial property is closing, and sort of adjust in terms of what we're doing plan wise or strategy, right?
Totally. Yeah, I think that makes sense. So next question is about mortgage insurance. Do I need mortgage insurance, and how does it differ from home insurance?
Yeah, no, for sure. So mortgage insurance is something that is part of the conversation when you have less than 20% down payment.
Okay.
Right. That's where you're going to find it mostly is if you can't obviously put the 20% down. What happens is your mortgage institution or whoever you're getting your mortgage from,
Yep.
They actually pay a premium in order to insure your mortgage, and they just pass those costs down off to you, right?
Okay.
So the one thing about mortgage insurance where people sort of have a negative thought over or a negative stigma is it's always a bad thing, right? I look at it as you don't have a down payment, you still have the option to get into a home, right? A couple things, the home does have to be under $1 million.
Okay.
Right? And the other thing is that insurance actually gets amortized or put throughout your entire mortgage, right? So it's not something you're paying up front. It's not going to be a massive burden in terms of cost. It very marginally affects your monthly payments.
Okay.
But it is something that's spread within the entire term and amortization of your mortgage.
Okay,
Yeah.
that totally makes sense. And
Yeah.
I mean, it's called an insurance. So what is it actually insuring?
So it's insuring yourself in the instance of a default.
Okay.
Or the lender in the instance of a default, right?
Okay.
Just because it is a higher risk mortgage, there's less equity that you actually have. The bank has the most equity in that home, essentially, right? So it's just to cover their end.
Okay.
Right? Yeah.
Totally makes
Yeah,
sense.
yeah.
And that's under $1 million, putting less than 20%.
Less than 20% down.
Okay.
Yeah.
The next question is about refinancing options. So what options do I have for refinancing my mortgage if I need to access additional funds for home improvements or other purposes?
Yeah, so that's going to be for home improvements and other purposes. I always sort of resort to the HELOC, right? That home equity line of credit.
Okay.
A lot of people use it just as a rainy day fund.
Yeah.
Right? You know, if anything does happen, we have this access to funds, which is great, right? Now, the HELOC is perfect for, you know, let's say small home improvements, maybe an investment. Just wrapping back to what I said prior was you can make interest-only payments on a HELOC.
Right.
Right. You can minimize your monthly payments on this equity that you're taking out. Right. So when it comes to that, it just gives you the flexibility, right? You never know what can happen, but you still want to obviously fix your kitchen, do your floors, maybe something crazy, make a mud room,
Right.
you know?
Yeah.
But accessing your equity with a home equity line of credit is something that is probably most recommended for this type of situation.
Yeah. I love that. Okay, cool. My next question actually came from my Instagram, Dyson Realty. If you're looking to get a little behind the scenes, that's definitely where you want to check out. And this question is actually about rate locking around the interest. So can I lock in an interest rate, and for how long, especially if I'm planning to buy in the near future?
Yeah, for sure. So you can lock in interest rates. It's generally 120 days, which is where you'd be able to lock in that rate.
Yeah.
In order to lock in that rate, you do have to go through an entire process of a mortgage application.
Okay.
Right? Now, when doing so, when we do lock in your rate, we actually set you up to, if you were to find a home within that 120 days, you're ready to close.
Okay.
Right? But yeah, it's usually 120 days. You'd be able to save that rate. And especially in this market where we are looking to see things come down as the year progresses, a rate hold is not necessarily something that you do need. We usually do recommend in an instance where we do see rising interest rates.
Yeah.
But you never know, right? It's better to be safe than sorry. So getting a rate hold is something that is appropriate to do. And also you get to see your affordability, right? I think that's very important in any stepping into any transaction, right?
Yeah. We actually have a real case client that we have kind of under contract right now.
Yep.
She's already bought in something. And we're actually we're waiting to see what the best rate is. Can you expand a little bit on that?
Yeah, for sure. So when we are able to submit offers and actually submit a package to a lender, we do have the opportunity most of the time to pick up on a lower rate, getting closer to their closing date.
Okay.
Right. So for this specific client, she's great. We are actually just holding off a little bit in order to let the rates settle a little bit. Right. So she is a fixed rate client.
Yep.
And when we're looking at fixed rates, we have to look at the 5-year bond for Canada, the bond yield, right? So we are monitoring that, keeping a close eye on it. And then as soon as I do see something settle, that's when we're going to be locking in her final rate and getting her home closed.
I love that.
Yeah.
This is why I absolutely love working with you and your team, because they really truly look out for the client. Even after we have an approved, accepted offer,
Yep.
you're still advocating, and that's why I love working with you guys. So thank you on behalf of the client. You know who you are. You're out there. I think this is a perfect transition to the questions that we got from our home buyers.
Yeah.
So this next question is, what types of mortgage loans are suitable for first-time home buyers, and what are the pros and cons of each?
For sure, for sure. So it really depends what your goals are, right? A question I love to ask very frequently when speaking to a client is why.
Yes.
Right. So it really depends on what's going on. Maybe they want to start a family soon. Maybe they are going into this with somebody else. So there's less of a risk, let's say, on their end.
Yeah.
So there's a whole bunch of different factors. But in terms of what we'd be looking at for, let's say, a first-time home buyer, generally speaking, would be a 5-year fixed rate.
Okay.
Right. 5-year fixed rate is going to offer you the best affordability, it being the lowest rate out of all the fixed rates.
Yep.
Right. Which means your qualifying rate will be lower as well. Right. So first-time home buyers is going to be usually that type of rate. It could also be a variable. Right. It's going to depend on exactly what you want to do. Right. People that are generally starting to build a family or hoping to build a family, I would say the 5-year again would be a great product just because it offers you that security, right?
Because you know what you're going to pay.
You're not going to be paying 5 years every month, right? Now, in the instance where rates come down significantly within your 5-year term, and it makes sense to break, given that the interest savings is going to be more than whatever penalty you're going to be paying, that's when I would say break your mortgage then, or we'd be able to at least look and entertain that idea for you. Yeah.
Okay, cool. And if you're new to mortgages completely and you have no idea what a fixed is versus variable, really, really quickly, what is kind of the points of difference?
Yeah. So huge difference, fixed and variable. When you are getting a fixed rate mortgage, that's going to be your mortgage rate throughout the term or the amount of years that you have set, right? Where you look at a variable, that variable rate's consistently adjusting to the prime rate, right? So when you initially get your mortgage with that lender, you could have a prime minus, which is an incentive on your variable rate, and that will just keep on adjusting as that prime rate moves, right? So both are great. In this market now, what we are seeing is a variable rate would probably be the most favorable. And historically speaking, if you do look over time, even with the cycles that we do have in terms of interest rates, variable rate is still the cheaper option to go.
All right, let's move on to down payment. So for first-time home buyers, down payment and that affordability piece is probably the biggest barrier to the market. And we have a question. Are there any specific down payment assistance programs or grants that cater to first-time home buyers in the Toronto West area or in Ontario?
Yeah, for sure. So there are a couple different things that you can do in terms of down payment assistance. One of them it's not necessarily getting a down payment, but to help out in the situation would be a high ratio mortgage, right? So that's going to be across a whole bunch of lenders that offer a high ratio or the less than 20% down, right? Obviously, you are going to be paying that insurance premium like we discussed, but it does give you an option to get into that home without having that 20% down, right? Now, another interesting thing is there are companies that are coming out, one of them being Our Borrow, which do actually help top up that additional amount that you need for down payment, right? Now, there are sort of set criteria or set limitations when it comes to using Our Borrow, but that is something that once somebody comes to me and they say, hey, you know what, we're looking in this area, this is our budget, this is what we have, that's when we can go through the details and see exactly what it'll entail to get into a product that Our Borrow supports. And that other institutions would be using as well in combination with Our Borrow.
Very cool. I'm actually an Our Borrow partner, and they have some really great programs, and their client services
is excellent, really right? Great. It's excellent. It's great what they're doing.
Yeah. Awesome. Let's talk about the pre-approval process. So can you walk us through the pre-approval process and how long does that typically take to get their pre-approval, and then we can start shopping?
Yeah, for sure. So pre-approval process, it's It's my favorite process.
Right.
It's where I get to really dive in deep and discuss with the client exactly what's going on with their mortgage, right? In terms of turnaround time, it'll really depend on the market. Obviously, it'll depend on the client as well.
Yeah.
But usually we say 24, 48 hours is what we'd be looking at in order to get some numbers back for your client.
Okay.
Right. I give that time frame there because obviously people are busy. It could take a little while to get an employment letter or your pay stubs or whatever it may be. But we do have a set amount of documents that we do require, right, prior to getting the pre-approval. So for somebody that's employed, which is going to be more often than not, hopefully, yeah. Well, it's employed versus self-employed, right? So the employed is something that we do see more often. So that would be your 2 most recent pay stubs, your letter of employment, your 2 most recent T4s, and then obviously if we are looking for you are looking to purchase, we would need 90 days of your down payment history.
Okay.
Right. So that's not stuff that's necessarily for myself. It is obviously to validate income.
Yeah.
Validate employment.
Right.
But it's also for the lender, right? All the lenders are going to be requiring these documents. So when we go through the pre-approval process, we package it all together. So once you do get an accepted offer with Jay, we attach that to the file and it's already completed, right? So it's less of a hassle for the client going back and forth saying, hey, we need this, we need that. But it also gives the client a better understanding of exactly why I need each document. And we can go into details of exactly what that means, right? Like I want the client to leave the situation or leave the transaction as a pro, right? They'll be a real estate pro, they'll be a realtor, they'll also be a mortgage agent. In a sense where they have more education than what they initially came to the deal with, right? So, yeah.
Totally fair. I love so you actually provide with your pre-approval kind of like a budget sheet where it breaks down the cost and you take it all the way down to like a monthly cost. That's including insurance, taxes, that's including maintenance fees if you're buying a condo. So you really, with that document, I take my clients through properties and we know fully what we can afford,
what to expect,
and
right?
what to expect.
Yeah, exactly. And it's small things like that, like the budget sheet, where I do feel like it makes a difference, right? And end of the day, you want the client to be entirely comfortable with what they're doing, the transaction they're stepping into.
Totally.
Right. And when somebody can really see the numbers, exactly what it's going to cost monthly, besides the mortgage cost, right? Putting that all together, it brings a sort of reality to the situation, right? It's going to bring comfort. It's going to make it more enjoyable for everybody, right? Yeah.
It also makes your offer a lot stronger when you have that pre-approval. So I can advocate on behalf of that pre-approval and give the seller or the seller's agent confidence that they have the financing.
They have the financing,
and it just kind of makes it a little bit more solid.
For sure.
Great. So another big question, what closing costs should I be aware of and how much should I budget?
For sure. So we generally want to see 1% to 2% in terms of the mortgage amount for your closing costs or your purchase price for your closing costs, right? Doesn't necessarily mean it's going to reach that amount, but it's just for sort of a safety net, right? Now, in terms of closing costs, when you are purchasing, that's going to be your legal fees, your land transfer tax, your mortgage insurance, if you do have it, right? And then obviously your deposit and your down payment. That's what I would sort of consider your closing costs.
I would agree.
Right?
Yeah.
So as we mentioned, we do have a budget sheet. We're able to plug in all these costs and sort of give you a rough idea of what you're getting into, right? But it also helps you, maybe your closing is going to be 90 days out from today. We're able to actually go in and buy you a little bit of time if, let's say, you do need those additional funds. Maybe you're going to be getting a gift from your parents or whatever it may be. It gives us a little bit of time to work with.
All right. Our last question is around repayment terms. So can I choose the length of my mortgage term and what are the implications of the different term lengths?
Yeah, for sure. So generally speaking, you can pick the term, right? That's entirely up to you. But there are pros and cons for going with each term.
Okay.
Right. So like we saw last year, interest rates starting to come down. The term length would generally be, let's say, 1, 2 to 3 years, right? People want to try to time the market as best they can. Obviously, you can't time the market. We all know that.
No, I wish.
Yeah. But it does give you a little bit of room to work with, right? So In terms of term length, it can be 1, 2, 3, 4, or 5 years.
Okay.
Right. When you are looking at a 5-year term, whether that be on the variable side or fixed rate, you are looking at generally lower rates. Right. This is just due to yourself being with that institution for a longer period of time.
Right. Yep.
So they're more incentivized to give you that lower interest rate.
That makes sense.
Right.
Yeah.
Now, like I was mentioning, you can adjust the term lengths depending on what your goals are. Right. So a lot of time when I do have somebody that's looking to, let's say, even flip the property in the next 3-4 years, that's when we put them on a 3-4 year mortgage. Right. So why would we put them in a 5 and they have to break it after, right? Because when you do sell and you're within that term, that's breaking that mortgage now, right?
Totally.
So with that being said, it really depends on what your goals are. It can differ entirely. But generally speaking, if you are looking at, let's say, purchasing your first home, it would probably be a 5-year fixed rate would be your best interest, just because it's going to offer you that affordability, right?
Makes sense.
Yeah.
Yeah. Okay, cool. That's all the questions that we have. Thank you so much for your time. One of the benefits of having guests join us monthly is we are asking for our guests to provide a free gift to you at literally zero cost. Tell us a little bit about your free gift that you're giving to the audience.
So my free gift is going to be our homebuyers guide. And what that homebuyer guide is going to have is everything that we just discussed today, actually, and also little tools that you have in there, right? So in there we have our budgeting, so what to expect in terms of any costs that you'd have with a real estate transaction. There's small little checklists in there, so we call it like the changing address checklist. So it's going to give you a little bit of a breakdown of exactly, make sure that you change your mailing address for X, Y, and Z, right? Don't forget your garage door opener, stuff like that, right? But within this is going to give you a great breakdown of exactly what to expect in terms of the mortgage process, and really leave you with a bunch of information that I think is very important when going throughout a mortgage transaction, right?
Totally.
Yeah.
I love that. So below in the description box, you'll see a link. Fill out that information and you will instantly get this buyer's guide from Mike and his team at the Vine Group. This resource is invaluable. There's so much information in there, and it's totally free for you. So why not take advantage of that? Mike, where can we find you? Where are you online? Tell the people, plug yourself.
Yeah, so I'm on Instagram. My Instagram is going to be at Mike Schinas. I'm also on TikTok. I think it's Mike.Schinas on TikTok. Somebody took the without the period in there. I don't know how that happened. But primarily Instagram is where you're going to be seeing a lot of my content. People can go ahead there and ask me questions straight through the Instagram. Make it super casual, right? I want everybody to feel comfortable reaching out, because this is a little bit of I don't want to say scary process, but it's a big move for some people, right? So you can reach out to me on Instagram. That's going to be at Mike Schinas, or my TikTok, Mike.Schinas.
Thank you so much for watching. My name's Jay Dyson. If you have questions about the home buying process or home selling process, my DMs are also open. You can follow me at Jay Dyson Realty. And until next time, we'll see you later.